Warren Buffett is a legendary investor. He is known as the Oracle of Omaha for his incredible success. Buffett's company, Berkshire Hathaway, has made huge returns for its investors. People around the world pay attention to his investment choices. Buffett's approach is surprisingly simple. He focuses on buying good companies at reasonable prices. This strategy, called value investing, has made him one of the wealthiest people in the world. What's amazing is that anyone can learn from Buffett's methods. His ideas are helpful for both experienced and beginner investors. By understanding his core principles, you can improve your own investment journey. Value investing is about finding hidden gems in the stock market. Imagine sifting through a crowded beach, searching for that one rare, sparkling jewel buried beneath the sand. That's what value investors do. They look past the obvious, hunting for companies that are overlooked or misunderstood by the majority. It's a patient, methodical process, not about chasing the latest trends or following the crowd, but about careful research and a keen eye for opportunity. You're looking for companies that are worth more than their current price suggests. This means digging into financial statements, understanding what a business truly owns and earns, and comparing that to what the market is currently willing to pay. Sometimes the market gets it wrong. Stocks can be undervalued for all sorts of reasons, from temporary setbacks to negative headlines. The value investor's job is to spot these disconnects and act on them. Buffett's strategy has a few key parts, each one designed to minimize risk and maximize long-term reward. He doesn't just buy any cheap stock, he's looking for quality at a bargain. First, he looks for businesses that are strong and profitable. These are companies with a proven track record, firms that have weathered storms, adapted to change, and consistently delivered results. Buffett wants to see a business with a durable competitive advantage, something that sets it apart from the competition and allows it to thrive year after year. He wants to see a history of earning money. It's not enough for a company to have a good story or a promising product. It needs to have a record of real profits, growing revenues, and healthy cash flow. This financial strength is what gives Buffett confidence that the business can survive tough times and continue to reward its shareholders. Second, he avoids companies that are overpriced. No matter how great a business is, paying too much for its stock can lead to disappointing returns. Buffett is disciplined. He waits for the right price, even if it means passing on popular opportunities. Just because a company is popular doesn't mean it's a good investment at any price. Hype and excitement can drive prices far above what a business is truly worth. Buffett reminds us that it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Finally, Buffett is known for holding his investments for a very long time. He's not interested in flipping stocks for a quick gain. Instead, he lets his investments grow, compounding in value over years and even decades. He's not interested in quick profits. Buffett's patience is legendary. He's willing to wait as long as it takes for his investments to pay off, ignoring the daily noise and short-term market swings. He believes that great companies will grow in value over many years. By holding on, he allows the power of compounding to work its magic, turning small investments into substantial wealth. This long-term approach is central to value investing. It's about discipline, patience, and a deep understanding of what makes a business truly valuable. By following Buffett's guiding light, investors can navigate the market with confidence, focusing on real value and lasting success. Before buying a company's stock, Warren Buffett does his homework. He doesn't just glance at a few numbers or skim the headlines, he dives deep into the details, determined to understand every aspect of the business. This careful research is the foundation of his investment strategy, and it's what sets him apart from many other investors who might act on impulse or follow the crowd. Buffett wants to know everything about the business he's considering. He starts by learning what the company actually does, how it operates, and what makes it tick. He reads annual reports, studies the company's history, and tries to get a sense of its culture and values. He believes that understanding the business inside and out is the only way to make a truly informed decision. He looks at what the company sells and how it makes money. Is it a product or service that people need or want? Is the business model simple and easy to understand, or is it overly complicated? Buffett prefers companies with straightforward operations, where the path from product to profit is clear. He avoids businesses he can't easily explain, no matter how tempting the numbers might look. He studies its financial statements carefully. Buffett pores over balance sheets, income statements, and cash flow reports. looking for signs of financial health and stability. He pays close attention to profit margins, debt levels, and how efficiently the company uses its resources. He wants to see consistent earnings, strong returns on equity, and a track record of smart financial management. Next, Buffett examines the company's management team. He knows that even the best business can falter if it's run by the wrong people. He looks for leaders who are not only skilled and experienced, but also honest and transparent in their communication with shareholders. Are they honest and competent? Do they act in the best interests of the company and its owners, or are they just looking out for themselves? Buffett values integrity above all else, and he avoids companies where management seems untrustworthy or self-serving. Do they make smart decisions? Buffett looks for evidence of good judgment, especially during tough times. He wants to see that management can adapt to challenges, allocate capital wisely, and plan for the long term rather than chasing short-term gains. A good management team is crucial for a company's success. The right leaders can inspire employees, build a strong company culture, and steer the business through both good times and bad. Buffett believes that great management can make a good business even better, while poor management can ruin even the strongest company. Buffett also looks for companies with a moat. In the world of investing, a moat is a metaphor for a company's ability to protect itself from competitors. Just like a castle with a wide moat is hard to attack, a business with a strong competitive advantage is hard to beat. A moat is a competitive advantage that protects a business from its rivals. This could be anything that makes the company unique or difficult to copy, like a powerful brand, exclusive technology, or a network of loyal customers. The wider the moat, the safer the business is from competition. It might be a strong brand, a unique product, or a loyal customer base. Sometimes it's a cost advantage that lets the company offer lower prices than anyone else, or a patent that keeps competitors at bay. Buffett looks for companies whose moats are growing wider over time, not shrinking. A wide moat makes it hard for competitors to steal market share. It means the company can keep its customers, maintain its profits, and survive even when new rivals try to break in. This kind of protection is what allows a business to thrive for decades, not just a few years. Companies that earn steady money and have few strong rivals are ideal for Buffett. He prefers businesses that generate reliable cash flow year after year, regardless of what's happening in the broader economy. These are the companies that can weather storms and keep growing. He also considers how the company's moat might change in the future. Is it getting stronger, or are competitors catching up? Buffett avoids businesses where the moat is shrinking, even if the current numbers look good. These are the types of businesses that can withstand economic downturns and continue to grow over the long term. By focusing on strong fundamentals, honest management, and durable competitive advantages, Buffett aims to invest in companies that will stand the test of time and reward their shareholders for years to come. You don't need to be a financial expert to invest like Warren Buffett. In fact, some of the most successful investors started with very little knowledge and learned as they went along. The key is to take that first step and commit to learning. Investing can seem intimidating at first, but with a little patience and the right approach, anyone can get started and make progress toward their financial goals. Here are some basic steps to get started. Simple actions that can make a big difference over time. Think of these as building blocks for your financial future. First, know your risk tolerance. This means understanding how much uncertainty you can handle when it comes to your investments. Some people are comfortable with big swings in value, while others prefer a steadier, more predictable path. Ask yourself, how much risk are you comfortable taking with your money? Would you lose sleep if your investments dropped in value, or would you see it as a normal part of the process? Knowing your comfort level will help you choose investments that fit your personality and financial situation. Next, consider your time horizon. Are you investing for the short term or the long term? Your goals might be just a few years away, like buying a car or going on a big trip, or they could be decades in the future, like saving for retirement or your child's education. After that, set clear financial goals. Write down what you want to achieve and by when. This could be anything from building an emergency fund to saving for a down payment on a house, or even starting your own business one day. Ask yourself, what are you saving and investing for? The more specific you are, the easier it will be to stay motivated and track your progress. Maybe you dream of owning your own home, or perhaps you want to travel the world, or ensure a comfortable retirement. Whatever your goals, make them clear and realistic. Having specific goals will help you stay focused, especially when the market gets bumpy. Then, diversify your investments. This means spreading your money across different types of assets, so you're not relying on just one thing to succeed. Don't put all your eggs in one basket. If one investment doesn't do well, others might perform better and help balance things out. Spread your money across different types of investments such as stocks, which can offer growth over time but may be more volatile in the short run. Bonds, on the other hand, are generally more stable and can provide steady income, while real estate can offer both growth and income potential. By mixing these, you can reduce your overall risk and increase your chances of steady returns. By following these steps, you'll be building a solid foundation for your investment journey. Remember, it's not about making quick money, but about growing your wealth steadily and safely over time. Remember, investing is a marathon, not a sprint. Stay patient, keep learning, and let your money work for you. With discipline and time, you'll be amazed at how far you can go. Patience is essential in investing. The stock market goes up and down in the short term, and honestly, it can be a bit nerve-wracking. Don't panic and sell your investments when prices drop. Instead, remember why you invested in the first place. Trying to time the market is difficult, even for experts, so don't waste your time trying to guess short-term price movements. Instead, focus on finding good companies and holding them for the long haul. Buffett's success really demonstrates the power of patience and discipline. By ignoring the market noise and sticking to his strategy, he has achieved extraordinary results. Finding undervalued companies takes time and effort. You need to learn how to read financial statements and understand what makes a business tick. Here are some tips. First, read company reports. Look for information about the company's products, services, management team, and financial performance. Next, analyze financial ratios. Use numbers like price-to-earnings ratio and debt-to-equity ratio to assess a company's financial health. Also, utilize research tools. Websites like Yahoo Finance and Google Finance provide valuable data and analysis on publicly traded companies. Remember, investing is not gambling, it's about owning a piece of a business. So do your research and make informed decisions. For new investors, starting with a simple portfolio is often best. Consider these options. First, index funds. These funds track a specific market index, such as the S&P 500. They offer instant diversification and are low cost. Second, blue chip stocks. These are stocks of large, well-established companies with a history of profitability. They tend to be less volatile than smaller companies. Third, dividend-paying stocks. These companies pay a portion of their profits to shareholders in the form of dividends, which can provide a steady stream of income. As you gain experience and confidence, you can start adding individual stocks to your portfolio. But remember to diversify and avoid putting too much money into any single investment. Investing is not a set-it-and-forget-it proposition. Your financial goals and circumstances may change over time. It's crucial to review your investment portfolio regularly, at least once a year. Ask yourself these questions. Are my investments still aligned with my goals? Have any of my holdings become overvalued? Are there any new investment opportunities I should consider? Based on your answers, make adjustments to your portfolio as needed. Rebalance your holdings, sell underperforming investments, and add new ones that fit your current strategy. If you found this video helpful, please consider liking, sharing, and subscribing for more informative content.